Welcome to Kickin' with the Rickens, redefining retirement. Gerry Ricken and Heidi Ricken Provost want to help you retire with purpose and live with joy. Find more information, including how to reach the team, in today's show notes. Now, Kickin' with the Rickens, powered by Ricken Financial.
Thanks for subscribing. Thanks for downloading. Thanks for listening to Kick In with the Rickens podcast. We are here with licensed insurance professional Gerry Ricken. My name is Mark Owens. We invite you to get more at rickenfinancial.com. You can get all the information here in the show notes. Thanks again for subscribing. Now, let's get to the show. And Gerry Ricken, everything is right in the world.
You know, it is, Mark, and you know, it is so exciting. It's April. It is Cardinals baseball is back. And when I say Cardinals baseball is back, I know we're recording this. Let me just tell you, opening day was spectacular. Opening day in St. Louis is like no other opening day in my mind because, you know, the Clydesdales come out. We see the Clydesdales march around Busch Stadium. We see everyone that can be there in a red jacket, a member of the Cardinals Hall of Fame, being paraded out, you know, in a convertible. And they all end up at home plate. And then each one of the players is announced and they get to shake the hand of everyone that's been there before them who's wearing a red jacket. It is just a magnificent day. It was beautiful. It was a little warm. It was 94 degrees.
Yeah.
And in March, 94 degrees is pretty warm in St. Louis, but the next day it was 50. The Cardinals were hot as well.
Yeah.
And it was a good time for all 45,000 in attendance and certainly the players on the field. So,
yeah.
And then they topped that off with a walk-off hit by a rookie to win in the 10th. It's just fun to see the youth back and the enthusiasm back in the crowds. We never know what's going to happen in 162 games, but it's always fun to be in the ballpark. Any day in the ballpark beats a day, any other thing, doing yard work or being in the office.
Amen, brother. Amen. 100%.
Cardinals baseball is back, and you're back in baseball too.
Yeah, it's fun to be back, and it's so funny we're talking about this too because, you know, as we record this, we're a couple of days ahead of schedule, but I spent a long time working for the Atlanta Braves as their in-game host. I was my big fake teeth on the big screen in between innings, giving away prizes and talking to the players, and took a couple of years off and then came back this year and started back last weekend, and very exciting to be back. So good to be back. I didn't realize how much I missed it and how much I feed off the fans and how much I love baseball. And I'll tell you something, Gerry, and we were talking about this off the air. The headlines are very heavy right now. The noise, geopolitics, everything going on with the world, it can be exhausting. But when you're in that stadium watching baseball and everybody's wearing the same jersey, and it doesn't matter, Gerry, if you're old, if you're young, if you're black, if you're white, if you're Republican, if you're Democrat, it doesn't matter because for those 9 innings, we are all on the same team, and the only enemy is the visiting team, and we're all together on that. It is such a good feeling, and I think that's one of the big reasons they call it America's pastime.
Absolutely, absolutely. There's nothing like being in the ballpark and just smelling the fresh grass, eating your favorite ballpark fare, you know, drinking your favorite ballpark beverage, and just spending time with people and watching your favorite team.
Amen.
It is just a great, great time.
And I think, and we've said it before, I think, you know, obviously Braves, your Cards fan, I think the teams are very similar. I think we have a very respectful fan base towards each other, and I've had the opportunity to, you know, witness a game in your home park, and you've been to my home park, and it's just a lot of fun, and I think the fans on both sides just love this game. Now, when we play each other, all the gloves are off, and you are my enemy for those 9 innings. The rest of the year, I'm a big fan of your team.
And yours as well. And yours as well.
So I think, Gerry, and a good place to go this week here on Kicking with the Rickens, redefining retirement, 314-207-6211, rickenfinancial.com is, now that as April is here, we think about the Masters. We think about the return of baseball. But what should be top of mind? Taxes. Boy, it's a big month for taxes. So let's talk about taxes. What do we need to know? We'll get to some misconceptions. Where do you want to start, Gerry?
Well, you know what? Let's talk about tax prep. If you haven't prepared your income taxes for 2025, please do so. April 15th is our deadline, as it is every year. And that is for preparation for filing your income tax return and also paying your income taxes. A lot of people say, well, could I just extend because I can't afford to pay my taxes right now? Well, those two are mutually exclusive. When you extend, you still have to pay on time. You have to pay by April 15th. You can extend for a number of months after April 15th to get the paperwork performed and in to the service and to your local and state taxing authorities, but you have to pay on time. When I talk about tax preparation is my least favorite part of taxation, because tax preparation is recording what happened last year. Well, can we do anything about what happened last year? For the most part, no. Yes, you may be able to still by April 15th contribute to your HSA account or open a Roth IRA, but that's about it. All the numbers are the numbers from 2025, so we just need to report on that. My thing when I talk about taxation, I talk about tax season. Tax season to me is year round, and that's tax planning season.
Right.
We are financial planners, and we focus on tax forward financial planning. When we meet with people, they say, well, my guy doesn't talk about taxes. If your guy doesn't know or talk about taxes, you're probably missing the biggest expense that you can control for the rest of your life. Let me tell you that for sure, because taxation is the largest expense we will have in our lifetime. So why wouldn't we want to reduce that? Let me just give you a little example. If you took $1 and doubled it for 20 years without taxation, at the end of 20 years, you'd have $1,048,000 and change. That's $1,048,000 and change. Okay. If you just put 10% tax, and 10% tax is a low tax, in the 20th year, you'd have $375,000. You'd lose $672,000 to taxes in that 20-year period. Let's say you're more in line with 25% state and local income taxes. Well, you'd lose $976,000. Your $1,048,000 would be at $72,000 in 20 years. Well, let me just ask you this question. If you could get closer to the $1,048,000 than the $72,000, would you be interested in talking to someone about that? If the answer is no, we need to check you for a pulse, because we would like to have that discussion with you, because you can control your taxation. And when you pay the taxes will matter the most. And how you pay the taxes will matter the most. How you invest what into what. What tax strategies into what investments will matter the most the rest of your life. So we don't want the IRS to be your biggest beneficiary, because, quite frankly, I believe that you're a better steward of your money than the IRS is. You know how to spend your money better for your family than the IRS does for all of us, or the federal government does for all of us. So if you'd like to have that conversation, please reach out to us at 314-207-6211. It's a complimentary consultation. We just sit down, understand where you are and where you want to be. And when I tell you you can be tax-free in retirement, you can be tax-free in retirement. There are some situations where we can't get you completely tax-free, but we can get you darn close to being tax-free in retirement. And that's the point in time when we want you to have more freedom to spend money. We want you to have more ability to spend things that are not going to be taxable on making sure your health care is in order,
right?
Making sure your family's taken care of, making sure your spouse is taken care of in the event that you pass away. All those things have a tax element in them. And if we can reduce that taxation, you are better off in retirement than anywhere else that you can be, if you can focus on that one thing, because that one thing will be biggest expense in your lifetime if you don't focus on it.
And we're going to spend some time here coming up over the next 30, 45 minutes, breaking down some of the biggest misconceptions that adults face to and through retirement about their tax strategy. But tell me again, the difference between tax planning and tax prep, because I think that's where a lot of adults get tripped up. So give me the Cliff Notes version, the ChatGPT version, tax planning versus tax prep.
Tax prep. Let's start with tax preparation, because that's what everyone thinks about when they think of taxes. They think of tax preparation. They think of making sure they get their ducks in order and get all of their material to their tax preparer so they can prepare their income tax return by April 15th. And I'm talking about individual income tax returns. So that is what happened last year. That is the history of your tax life. So there isn't much you can do about history. You can read about history, you can talk about history, but you can't change history. So you can't change what happened last year. And that's what tax preparation is all about. Tax planning is history that is yet to be written. And can you change the future? Yes, you can. you can predict the future with some certainty with respect to taxes, because you can utilize the Internal Revenue Code to your advantage. The Internal Revenue Code has all kinds of bells and whistles in it that you can take advantage of. The tax code is written to your benefit. It isn't written to your detriment. It's written to your benefit. And taxes are on sale right now for an extended period of time because of what happened on July 4th of last year. With the One Big Beautiful Bill Act, we have seen people's taxes come down. And we believe that's going to happen for the next few years. So we need to take advantage of planning for that.
Gerry, before we get into some of the biggest misconceptions and myths about taxes, what is your take on especially this time of the year, you see the people standing on the side of the road, on the curb, on the intersections, dressed up like a Statue of Liberty, shaking the sign that says, I'll do your taxes. Come inside the shopping center. Let's do your taxes. What's your take on those companies?
Those companies are built for one thing, Mark, and that is preparing income tax returns for the masses. And when I say for the masses, I'm not sure that if I owned 3 rental properties and had some other complex things in my tax return that I would go there and get that return prepared. But if I had a W-2 and a 1099 INT, which means I had interest income on a bank account, and I had a W-2 from my employer because I had earned income that year, that may be a nice place to go. But that's truly about preparation, not planning. So you would never go there to say, hey, what should I do in retirement? They would look at you because a lot of times they don't hire seasoned preparers that are tax accountants that have an accounting degree like we do here, because we look at everything from a tax perspective here, but we're also qualified to do that because I have an accounting degree.
Yeah.
And I've prepared taxes and I've done tax planning for my entire career. So when we're doing our financial planning for people, we want to make sure that they know what they can do from a tax perspective, because as I've said before, taxes are going to be the most expensive thing you'll have in your lifetime, but you can reduce that expense if you appropriately plan. But it does nothing to do with preparation. Tax preparation is just say, hey, what happened last year? That doesn't matter.
Yeah.
It's what happens this year in the following years until the rest of your life and even after you're gone.
Okay. So if I'm hearing you right, nothing wrong with those Statue of Liberty tax outfits, but they're just more for putting together your taxes from the last year. They're not going to help you put a plan together moving forward.
No, sir.
All right. So let's get to some of the biggest tax misconceptions. And this is the big one, Gerry. Number 1, adults who think, oh, Gerry, my taxes, they're just going to be lower in retirement.
Well, we have had individuals come in and say that and think that, and then we've prepared our tax plans for them and our retirement plans for them. Unfortunately, the IRS is probably going to be their biggest expense in their lifetime in retirement. And why is that? Well, a lot of people have saved most of their retirement funds in tax-deferred vehicles, 401ks, IRAs. And when you take money out of those, they're all taxable. So if you just think about it, and when you get into retirement and you're drawing Social Security benefits, well, guess what? Those are taxable. When you are paying your Medicare premiums, you've already paid into Medicare your entire life when you prepared your taxes or you did your W-2. But when you pay that during your lifetime, you also have to pay premiums to the government for the plan, the Medicare plan. Well, those are, in my mind, a tax, and they can go up in retirement based on your earned income. There are all kinds of taxation that are out there for seniors that don't exist for others. If you miss a required minimum distribution, you have to pay a 25% tax penalty. All these things add up. And we have not seen any of our clients, when they come in with their information, say, here's what it looks like. If they just didn't make any changes, they'll pay more in tax or the equivalent of tax in their retirement years than they will while they're working. And their taxation goes up when their spouse passes away if they're married. So we don't want you to be in that situation. And that is a huge misconception because a lot of people just think, when I retire, the IRS is going to retire with me. No, that's false. The IRS will be there with their hand in your pocket all the way along. And it just amazes me that people just think that way because, we've all been indoctrinated with a lot of things in our careers. And early on, when the 401k came out, we were told, you know what, put your money into this thing because you're going to get a tax deduction. This is replacing pensions. Pensions are now a part of our history because pensions don't exist that much for anybody out there, except unless you're in the public sector. Very, very few independent organizations have a pension for their employees. There are labor unions that have pensions. There are some medical facilities still have pensions. Your public workers have pensions, and your teachers have pensions. But the ordinary person that's out there working for a company typically does not have a pension, because 401ks replaced pensions. They put the onus on us as taxpayers to figure out our retirement plan. It was no longer, you retire on Friday, they hand you a gold watch and they hand you a paycheck for the rest of your life called a pension. Now you don't get the gold watch, and you get the opportunity to pay tax on your deferred 401k the rest of your life, and you have to figure out on your own. So when you think about, the IRS is going to retire with me, they won't. So what we need to do is make sure that we effectively plan everything that we do so that when we come to the point in retirement and we close that door for the last time, we walk out and we say, hey, I'm free, I'm easy, I want to be tax-free in retirement. You can't be tax-free in retirement unless you start today.
That's right.
And starting today is the most important thing you can do. It isn't about tax preparation anymore. It's about tax planning. What are you doing today? If today you start tax planning, it's never too late. Yep. Some people say, well, gosh, I'm already retired, I can't tax plan. Yes, you can. You can certainly tax plan when you're retired. You can tax plan before retirement. The earlier that you start, the better off you will be. But taxes are on sale right now. They truly are. So we need to take advantage of what we can do with the tax code in designing our tax life so that it reduces our tax in retirement and potentially eliminates it. So when people say, oh my gosh, there's no way I could never pay taxes the rest of my life. Yes, there is. It's a matter of when you pay them, how you structure things, and not necessarily saying, oh, I'm not paying taxes the rest of my life. You don't want to end up on the wrong side of the IRS by not paying your taxes. Yes, you're going to pay your fair share, but it's a matter of timing, how you do it, when you do it, and why you do it. Those are the three questions you need to be answered.
We've mentioned that a couple of times about how taxes are on sale. Can you explain that to me?
I believe taxes are on sale because we have kicked the can down the road for several years on our income taxes. We've lowered income taxes, but we continue spending in our country, and we continue growing our debt. And I think that eventually we're going to have to reduce our debt or pay the interest on our debt. And as interest rates increase, your interest on our debt increases. So that becomes one of our biggest budget items annually in our country's budget. So how do you do that? Well, the government raises money by receiving taxation. And if the revenue is lower than the expense, we're in a deficit spending. We've been in deficit spending for years. Okay. So we borrow money to pay the difference. Well, borrowing money creates interest expense in our budget. So if we continue doing that and doing that and doing that, eventually the interest on our debt will be the largest item in our budget. We have to control that at some point in time. We have Social Security that's a broken system because it's scheduled to run out in a few years and only have 70-some cents on the dollar to pay our beneficiaries in that program. We have a Medicare system that is underfunded. We have a Medicaid system that is underfunded. We have lots of things that need focus, and the focus is they need funding. Well, where does funding come?
Yeah.
Funding comes from our taxes. What will eventually have to happen is taxes will have to go up. We will have to pay more in our income taxes to pay for things like Social Security, to make sure that, the 60% of Americans who only have Social Security in retirement can still live. And that's a huge part of our GDP as well. So we need to focus on what's available right now. And after the One Big Beautiful Bill Act was signed on July 4th of last year, the tax structure is set in a permanent position. Now, when I say permanent position, you can't see the air quotes I'm doing right now when I say permanent.
Yeah.
Because we know that anything that has to do with the tax law, the one constant is change. So we don't know how long these tax rates are going to be out there, but we know they aren't going to be out there for our lifetime. And I'd like to have a show of hands out there of who thinks taxes are going down in their lifetime. Nobody will raise their hand because we believe that taxes will be going up because they are so low right now. We need to take advantage of what's out there. So if you want someone that holistically plans for you, call 314-207-6211. Sit down and have a complimentary conversation with Heidi and I. And Heidi's even more sharp on taxes than I am. And I'm very proud of her because she calls herself a tax nerd.
That's right.
She's a tax nerd with a personality.
That's right.
So it's easy to talk to her, and she makes it simple because taxes don't have to be as complex as people make them, but people make them complex so they can charge, big hourly billing rates. And those are the big box tax firms out there that are doing consulting work. We do all of our tax planning for our clients on a complimentary basis. So come see us. We'd love to have that conversation because there's no time better to start than today.
Biggest misconception about taxes. Social Security isn't taxable. Why is that a misconception?
Well, that's a misconception because that's a false statement. So when I talk about Social Security, a lot of people say, well, my gosh, Social Security was a tax when I paid it in because it was withdrawn from my paycheck and I paid into this system. So what Social Security does, and these figures have not changed since they put the taxation in. And by the way, it used to be that statement was true before 1983. Okay. In 1983, we had a trustees report from the Social Security Administration. The Social Security Administration has a board of trustees, and they are required to issue a report on a state of the Social Security program each year. In 83, they issued a report that said it'd be broken in 84. So they needed to do something. Well, in 1983, prior to that, Social Security benefits were not taxable. In that year, 50% of your benefits could be taxable. So 50% of your benefits in 1984 were taxable, 50% were not taxable based on certain income levels. And then fast forward to 1993. In 1993, we had a budget crisis. And we said, we need to raise more money. So how do we raise more money? Well, we're going to tax our retirees a little bit more. We're going to say that up to 85% of their benefits of Social Security will be taxable. Now, why is that important? Well, it's important because the threshold here is not very high. When I say the threshold here is not very high, it's all based on provisional income. And if you don't know what provisional income is, that is because this is the only place in the entire Internal Revenue Code where the term provisional income is used. It is your adjusted gross income plus non-taxable interest on muni bonds plus half of your Social Security benefits. Whatever that number becomes, if it's less than $25,000 for a single person or $32,000 for a couple, then you don't pay Social Security tax. None of your benefits are taxable. Mm-hmm. Now, if that is between $25,000 and $34,000 for an individual, or $32,000 and $44,000 for a couple, then 50% of your benefits are taxable. Well, it doesn't take long to get to the 85% of your benefits being taxable because if that provisional income is greater than $34,000, 85% of your benefits are taxable if you're an individual, or $44,000 for a couple, then 85% of your benefits are taxable. So right now under current law, 15% of your Social Security benefits are not subject to tax. Yeah. Now, in the One Big Beautiful Bill Act, one of the things that President Trump tried to do last year was make Social Security non-taxable. In fact, that's what one of his platforms he ran on when he was running for president this time. He wasn't able to do that, but he was able to get an initial deduction for those that are 65 and older of $6,000 a year, $12,000 a couple, so that most people are not paying Social Security taxes this year.
We're talking about some of the biggest misconceptions about taxes and retirement, and Social Security is a big one because a lot of adults will be relying on that as a source of income in retirement. I got another one for you here. Adults that say, Jerry, I already paid taxes on my retirement money. How is that a myth? How is that a misconception? Or more importantly, how is it just a wrong way of thinking?
Well, a lot of people have saved in IRAs and traditional 401k programs, and they got a match from their company. If they were blessed with a match, that money went in there as well. And all that is growing. But the interesting thing is you have not paid tax on that. it came out of your paycheck, but that was a pre-tax. It wasn't an after-tax.
Mhm.
So you haven't paid tax on that money. So and you haven't paid tax on the growth of that money. So a lot of people do think that, hey, I already paid my tax, on my retirement funds. I'm going to just pull it out and it won't be taxable. It will be taxable at your ordinary income rates. Every dollar you pull out of a traditional IRA or a 401k plan, if it is not Roth, will be taxable. And some people believe that their match that their employer puts in, even if they use a Roth option, that their employer puts it in Roth. The only way that happens is the employer will put it in Roth and you pay the tax on it. So the employer does not pay the tax on that. So we just need to clarify that with a lot of people. So when you talk to us, and you can do that by calling 314-207-6211, we'll set up that complimentary consultation with you, and we'll just have a discussion to see where you are and what is taxable and what's not taxable for the rest of your life. And we'll see if we can mitigate some of that tax for you.
All right, another one here for you. RMDs won't really affect me. Oh, but yes, they will.
That is really one of the most fascinating things that we realize now, that we have most people out there that we're dealing with have had the opportunity to participate in a 401k program for their entire working career. And they received a company match, as I just talked about. When that happens, and everything is compounding, we've had some astonishing growth through the last several years, in a lot of years during our working careers. If we have a 40-year working career, 35-year working career, we've had a lot of growth in those investments because they've been in mutual funds. In the mutual fund industry, stocks, bonds have done well over the course of time. Mm-hmm. We've had a few blips, obviously, and we're in a little bit of a volatile market right now. But for the most part, everyone has been very successful in those accounts. And success is a great thing, but success in a tax-deferred account will obviously have consequences in the end. And the consequences are you're going to pay taxes at ordinary income rates for every dollar that you put into that account, and every dollar of growth you've had on that account, and every dollar your employer put into that account, and every dollar of growth that your employer's match received. So 100% of the proceeds coming out will be taxable. It won't be tax deferred if it's in a traditional 401k or an IRA.
All right, one more for you here before we take a quick break. All retirement income is taxed the same. Why is that a big misconception in tax planning?
Well, all retirement income is not taxed the same. When you think of it, we talk a lot about tax diversification. And when we talk about tax diversification, you have traditional funds that you've invested in that I just talked about, the traditional IRAs or 401ks. You have Roth 401ks, IRAs. You have 457 plans, 403b plans, and you can have either a traditional side of that or a Roth side of that. You also have HSA accounts, and you also have muni bonds, and you also, there are a lot, and you have a stock portfolio. Things are taxed differently. And when I say things are taxed differently, let's just talk about a stock portfolio.
Yep.
You buy a stock, you sell a stock. You buy it this week, it goes up 20% in the next 3 months, you sell it. You'll pay tax at a short-term capital gain rate on that transaction. And that rate is a lot higher than a long-term capital gain rate. A long-term capital gain rate is you buy a stock today, you wait 366 days, you sell it, you have a gain in it, you pay long-term capital gains rates on that, and that can be 0, 10, 15, 20%. It can be much, much lower than short-term capital gains rates. So it all depends upon how you invest and where your money is on how it is taxable. And if you don't understand that, you need to understand that, because one of the things that you'll save money in is how you withdraw that money in retirement. And when I say that, I mean, you don't want those required minimum distributions to be so large that you're making more money and paying more tax in retirement than you were while you were working. And we have seen that because the government dictates how much you take and how much you must take out of those accounts to satisfy the required minimum distribution. And that starts at age 73, 75. when you're 73 and 75, do you want to pay more tax than you did when you were 58 years old?
Nope.
I don't think so. I think you want to pay less tax than you did when you were working. So the only way around that is to structure your affairs so that you know how those required minimum distributions can be reduced. And a lot of that has to do with how your plans are operational from a tax perspective and what you're doing to plan for that from a tax perspective. Can you do a Roth conversion? Can you pay a little bit less tax now and save a whole lot more tax in the future? That's what we're really talking about when we're talking about that kind of planning and how taxes are going to impact each one of your streams of income. We like to have guaranteed income for life. Yep. We like to have guaranteed income for life that's tax-free. That's even the better. So that's what we're all talking about, is how you design your tax life with your income life.
All right, Gerry, a couple more for you. Some of the biggest misconceptions in taxes. What about capital gains? Some people think that, no, capital gains, they don't matter in retirement. How is that a misconception or a myth?
Well, that is a misconception because they do matter. There are two types of capital gains out there. One of them is a short-term capital gain, which means you purchase an investment and you sell that investment in less than 1 year. So that is considered a short-term capital gain. The other kind of capital gain is a long-term capital gain. And those are assets that you acquire, then you sell them after 1 year. That is considered a long-term capital gain. Why does that matter? Well, whatever ordinary income tax bracket you are in right now, and it could be 22, 24, it all depends where you are and how you're earning your income and what your tax bracket is right now. But whatever your tax bracket is right now, from an ordinary income perspective, is what you would pay tax on short-term capital gains. Short-term capital gains, I would equate that to earning income. It's no different than any other earned income. You're going to pay your marginal rate, whatever it is, let's say 22 or 24%. I'm just going to pick on those two tax brackets right now. You'll pay 22, 24% on your short-term capital gains. Now, long-term capital gains, let's talk about that. Long-term capital gains have different levels of taxation based on your income. And let's just pick on a couple right now. Married filing jointly. If you make less than $98,900, your long-term capital gain rate is zero. You pay zero tax on long-term capital gains. Then you pay 15% capital gains if your income's between $98,900 and $613,000. So then if you're over $613,000, you pay 20%. So most of you will fall in between 0 and 15% capital gains rate if they are long-term positions, items held more than 1 year.
Yeah.
Compare that with 22 or 24%, which is probably where those people are. So it makes a whole lot more sense to hold on to securities for over a year than it does for under a year. And if you're working with someone who's constantly creating gains and gains and gains, but you're paying 24 or 32% on those gains every time they hit, that probably isn't the best thing for you. So you have to really figure out what your tax is after that gain to see if it makes economic sense overall for you.
All right, talking capital gains. Now let's flip it to Roth accounts. A lot of people think that Roth accounts are only for younger people. Not so fast.
Not so fast. Roth accounts are for everyone. When I say they're for everyone, would you rather pay tax on everything that comes out of an account or pay no tax on everything that comes out of an account?
No
People
tax.
would pick B in that scenario.
Yeah.
So regardless of how old you are eligible for a Roth. And a Roth can be in the form of a conversion. A lot of people think, oh my gosh, I can't do a Roth conversion because I make too much money. No, that's a myth. That's a misconception out there. That's one of those misconceptions that a lot of people have. What we want to do is show you what a Roth conversion can do and can do for you in reducing your tax in retirement and in the future, because there's no better place to be than paying less tax when you aren't making money than paying more tax when you aren't making money. And that's in your retirement years. So we want to see if we can mitigate that taxation by seeing if Roth makes sense to you. Do Roth conversions make sense to you? Can you open a Roth account? So there are all kinds of rules out there on opening Roth accounts, but you can convert 100% of your assets to Roth from traditional in any one year. Would we recommend that? Probably not, because you pay tax in that year. So we strategically evaluate how much tax you're going to pay, what tax bands you're in, and making sure that this is an economical decision that's you're well informed of making. So if you'd like to have that conversation and figure out if Roth conversions are right for you, call us at 314-207-6211. We'll have that conversation. We'll analyze your portfolio. We'll analyze your taxes. We will let you know what makes sense. And you make all the informed decisions, because without information, you're shooting in the dark.
Amen. Again, 314-207-6211. All right, now this is probably a long-form conversation that we need more than about 10 minutes to cover, but Medicare has nothing to do with taxes. Big misconception, Gerry.
That is a huge misconception. Medicare has everything to do with taxes. Let's just talk about what Medicare is. When people think about Medicare, they get confused because, it's the ABCs of Medicare. There's Part A, there's Part B. Then there's all kinds of different plans you can get. Part D is your drug plan. There are all kinds of different plans out there outside of A and B. A and B are the government-administered, taxpayer-funded Medicare programs that are available for people 65 and older who are not on a group plan. If you're on a group plan, you do not have to file for Medicare planning. Let me repeat that. A lot of people think that they're going to get fined if they don't do something with Medicare at age 65. You don't have to frantically get into that mode. If you're currently working or your spouse is working and you're covered by an employer-sponsored plan, you can stay on that employer-sponsored plan until that insurance goes away. Then you're eligible for Medicare, and you will not be fined. You will not be penalized for entering the system after age 65. So let me make that one clear. At age 65, let's say you're on Medicare. At age 65, you apply for Medicare. Well, there's Part A and Part B. And Part B is a little over $200 this year. If you are collecting Social Security benefits, it will be deducted from your Social Security check. The Social Security Administration and Medicare work side by side and run that and make sure that they collect. If you are not receiving Social Security benefits, you will pay that out of pocket. You'll just be billed for that and pay that Medicare premium out of pocket. Well, the Medicare premium can increase based on your income, and it's 2 years ago income. So we're in 2026. We're talking about your 2024 tax return. What did it look like? If it said your income level were at certain levels, you will pay more than that $200 that I just talked about out of your Social Security check or your bill that you receive. And that can escalate and escalate and escalate in over $600 a month per person for Medicare based on what happened 2 years ago. And that's called IRMA. And we're not talking about my great aunt. We're talking about, that's an acronym for the cost of Medicare and what that tax is. No, I believe it's a tax because it's controlled by the government and they take it from you. So that is a tax, a Medicare tax. Even though we paid into the system our entire life based on what we earned, our earned income, we paid into Medicare. It still is a tax when you have to pay for a program that you've already paid into, and that can go up. So it has everything to do with how much money you make and how much money you're going to spend. And in fact, there's another caveat that a lot of people don't understand. If you have a Part D, which is you buy it from an insurance company, and a Part D is a drug plan, that drug plan has a cost in it as well based on your income. That plan can go up based on your income, will go up based on your income. So you just need to be very, very careful on how you plan your tax life with respect to Medicare. A lot of people say, well, my gosh, I don't want to do Roth conversions right now because that will increase my Medicare premiums potentially in 2 years. Well, we do an analysis, and a lot of times we find out that if you don't do that and rip the Band-Aid off for a few years and do Roth conversions for a few years, that for the rest of your life, you're going to be paying higher Medicare premiums because of the tax law. So we just want to make sure you understand what the implications can be by not doing Roth conversions or doing Roth conversions or doing any kind of tax planning that's available to you, because an informed decision is the only kind of decision you should make when you're thinking about your retirement life.
314-207-6211. Great conversation this weekend about misconceptions in your tax strategy. Jerry, we got about 60 seconds left here. Tell us about the Purpose Approach and how it could affect my overall retirement plan.
Well, the Purpose Approach is the name of our retirement planning program. When you come to meet us, the first thing we want to do is find out what your purpose in life is going to be when you retire. Your purpose in life, while you're working, we know what that was. Hopefully it's feeding your soul every day, and you go to work and you make an impact on the world. When you think about that, when you walk out of the door for the last time with your box of goodies out of your desk, what are you going to do? How are you going to spend your time? What's going to feed your soul in retirement? We want to know what's going to feed your soul in retirement. What are your wants, dreams, desires? We will build an income plan around that. We will build a tax strategy around that. We'll build an investment plan around that. What's your risk tolerance? We want to make sure you're meeting your risk tolerance. We will build a healthcare plan around that. Not only in Medicare planning, or maybe you're retiring before age 65 in healthcare planning, but what about long-term care planning? What happens there? What about the living benefits that are available in life insurance to you? And what about your estate planning and your legacy planning? What are you going to leave behind? What kind of footprint do you want to leave behind and leave as a legacy? All that wrapped in together is what we call the Purpose Approach. So come see us at Ricken Financial, and we would love to start that process. All it does is starts with an easy conversation. 314-207-6211 to get that thing scheduled.
Jerry, thank you. As always, thank you for the education and the information this weekend. We're back next weekend, but before we get out of here, Gerry Ricken, take us home.
Every day is a holiday. Life is short. Laugh hard.
This has been Kickin' with the Rickens, redefining retirement.
Insurance products are offered through the insurance business Ricken Financial LLC. Ricken Financial LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Tax preparation and tax advisory services are offered through Ricken Financial. These services are not offered by IPW and are not subject to investment advisor requirements. These services referenced are an outside business activity not offered through or supervised by IPW.